Greetings, everyone. This is Derek Jensen, and I will be presenting today on the issue or the question of tax planning for Washington estates. It's not just for estate tax. It's not just estate taxes. So we will be, I want to thank everyone again for coming and joining us. And today I'm really going to be running through the different issues and with taxes that we see that we try to look for when we're looking at someone's planning for someone. So we're going to be addressing some of how these interact with each other, considerations with those. We'll get into a little bit about what we can do with it as far as planning, but really it's trying to understand that there's more taxes that could be involved for everyone. The first issue that we do want to get to, though, would be actually the Washington estate tax. And let me show you what those tax rates look like and what that tax, and I'll discuss how that tax works. So if we do take a second to look at this slide here, we can see that the Washington estate tax exemption is currently $2.193 million. And we have tax rates of between 10 and 20% for that. The way that this really it becomes an issue for us, though, is that the Washington tax exemption stopped indexing about 6 years ago. And so if you remember what your estate was 6 years ago and kind of bring it up to today, you'll see what that issue is for folks. It's becoming bigger and bigger. Now, those tax brackets that we see there. So when we're looking, we see, 1 million to 2 million at 14%. That would be, 1 million above the 2.193 million. So if you had a $3.193 million your estate, you're going to have a 10% tax on $1 million. So it'd be $100,000 tax. And then for the next million over that, we'd be at 14% on the next million. So it's another $140,000. But those brackets have not changed since this tax was first introduced in the early 2000s. So those brackets seem a lot tighter now than they did 10, 15 years ago. And so we're seeing people climb those brackets faster and get into those higher and higher rates. And this is becoming a bigger issue for folks as we've seen a lot of appreciation in real estate and securities around, the Puget Sound area here and in Washington State in general over the last few years, with inflation really jumping and the like. We're not anticipating a lot of relief on this. It would be nice if the legislature went ahead and started looked at this issue and adjusted those brackets, and then also, potentially put indexing back onto for inflation on that, so that exemption amount of 2.193 million would increase. But again, we don't necessarily expect that to be happening. Now, what other issues are there with this? The big one that really comes in for planning purposes is the fact that we also don't have portability at the state of Washington level. So if you're familiar or looked at how estate planning is done, tax planning is done at the federal level, or if you remember how tax planning was done in the 90s here in Washington before we had our separate estate tax law, you may recall that how that plan works is for married couples, you'd want to put a portion of the estate at the first death into an exempt trust of some kind. It's gone by a lot of different names. Maybe the most easiest way to describe it and identify it is to say that it was a bypass trust. So the bypass trust would hold an amount of the exemption that was available, and so that at the second death, then that full exemption is being used. So you're able to use both exemptions. I kind of think of this as a coupon. So if you think that you each have a coupon of $2.193 million, and the Washington coupon says non-transferable. So you can't just give that coupon to your spouse. You have to find a way to use it. And it could be that you're making gifts to other people, but if you wanted to benefit your spouse, then that's why we would want to put it in that trust for your spouse, often called a bypass trust. The federal coupon, it goes with the federal exemption. It allows transferability to your spouse. So you can actually transfer that to your spouse. That feature is called portability, and that's another feature that would be nice to have here in the state of Washington, but unfortunately we don't. One other feature there, I think, when we're thinking about this bypass trust, is we should also be thinking in terms of how the assets that might be inside that would grow over the remainder of the surviving spouse's life. So, you can imagine if the assets in that, the 2.193, and I'm just going to round it to 2.2 for now. It's a little easier on us. But imagine that $2.2 million, and if it could grow at a 7.2% rate, then the rule of 72 would tell us that it would double in 10 years' time. And so it could be worth $4.4 million. That would be wonderful for estate tax purposes because that trust now is outside of the surviving spouse's estate. There would be no estate tax on it at the surviving spouse's death. Additionally, if it went for 20 years, it would double up again to $8.8 million. So, it'll have a lot of growth potential there, and that's generally a good thing. It gives the surviving spouse more security, knowing that they have those resources still available to them. It would also allow them to potentially do additional tax planning with their remaining estate. So that's one of the features that we look at there. One problem we do have in Washington is that we do not offer that same benefit, though. It doesn't work quite that way when we're talking about gifts to a non-citizen spouse. So we could still do the bypass trust, but the question here is, what about if the first spouse to die's estate was greater than 2.2 million? So if there was a $5 million estate, for example, normally we might put the 2.2 or so into that exempt trust, that Washington exempt trust. The other 2.8 million would be given directly to the surviving spouse. That's not a problem for U.S. citizens. That gift to the surviving spouse is fully exempt under what's known as the unlimited marital deduction. However, if it's a non-citizen spouse, then that would be a taxable gift, and that would require additional planning again to find a way to make sure we're not accelerating that tax and deferring that tax for as long as possible. So that's the real basics there of the Washington estate tax. So the next issue we really get into, though, is when we think about the tax is capital gains tax. And so let's take a look here at my slide on the capital gains. The capital gains tax is we're familiar with it for the federal purposes. It's really a tax on the difference between what you paid for a property or stock or real estate and what you end up selling it for. We have a top federal capital gains rate of up to 20%, and so that's the factor there. For Washington State, we also have a capital gains tax. This is only on securities currently, and it would be on sales of property, stocks, and securities that generated more than $260,000 of capital gain. So you could have then potentially 27% capital gains tax. And there's also another surtax in there that could be thrown in on the Affordable Care Act surtax of an additional 2.8%. So potentially we could have almost 30% taxes. And the reason this is important for us to recognize is that 30% capital gains tax is actually higher than our highest Washington estate tax rate of 20%. So what is the trade-off here? Are these two taxes related? And yes, the answer is because often uh, people will hold assets that have appreciated significantly at the time of their death. And those assets would be eligible for what's known as a step up in basis. It's really the fair market value basis adjustment at the date of death. And so you can revalue those assets. So, for example, you had some stock, maybe you purchased it for $10,000 and it's done really well. Maybe it's Nvidia or something here recently. But it could very well be Microsoft or Amazon or well, practically anything. If you've held it long enough, there's going to be a significant amount of gain there. But let's say that $10,000 worth of investment is now worth $250,000. That would mean that there's $240,000 of capital gain. And if you were in the top capital gain rate, you'd be looking at, 48,000 or so in tax on that. That tax, however, would be completely gone after death because the fair market value basis adjustment under IRS code section, Internal Revenue Code section 1014 permits this step up in basis. And it's kind of magic. And where we really see it often is people that hold real estate, investment real estate, maybe it's been depreciated and the like, or held for 40 years or more. This property has a lot of capital gains in it, so this is a really valuable step up and feature there. Unfortunately, you only get it at the time of death, but it can really make a big difference in taxes. So carryover basis is something that we also consider when we think about capital gains, because one solution to Washington estate tax is making gifts early. And we'll talk about, so this is the interaction between these taxes. You could reduce the Washington estate tax if you gave away your assets prior to your death. But if you're giving away assets that have appreciated significantly, then you would be losing that ability to get that step up in basis, and that the tax difference there could actually be greater than the tax savings you would get from not paying the Washington estate tax. So there's this interaction we really want to be careful of. I've gone ahead and put together a slide on that to show an example for a $1 million transaction. So here we're seeing the potential of a sale of a $1 million worth of highly appreciated stock that was purchased with $100,000. And we have two options. We could avoid Washington estate tax by making a gift of that, assuming that the tax, if you're in the 20% tax bracket, that would save you about $200,000 of Washington estate tax. However, that gift could actually cost more because as we look here, as we see that if the recipient sells that stock and they're going to receive carryover basis, meaning that their basis in it is the 100,000 that it was purchased for. There's going to be 900,000 of gain. The capital gains rate of 20% is $180,000 of capital gain tax, and again, we could also have that Washington capital gains tax on that large sale of securities of an additional $44,000. So the net proceeds or the total tax is actually going to be greater in this example than it would have been if the property had been held until death, received a step up in basis. Therefore, there's no capital gains, no federal capital gains tax or Washington capital gains tax. Yes, we'd have to reduce the $1 million of net proceeds there by the 200,000 in Washington estate tax, but we would still have a lower tax overall. And so this is the issue that we're really looking at when we think about the interactions between these two taxes. All right, let's go ahead and jump on over to the next tax that we'll chat about. And this one is really looking at income taxes. So we're all familiar with income taxes. Obviously, we're going to be paying income taxes as individuals. We're lucky we don't have an income tax here in Washington State. Uh, but what about the beneficiaries and how does that work? Generally, when you make a gift to a beneficiary of an asset that's generating income, now that's going to be their tax liability. So if they happen to be in a higher income tax rate than you, bracket than you, then they're going to be paying more taxes than you would have been. And if that happens, during life or at death, it's going to be really the same result there for income taxes. It also could be that we are making gifts into a trust. And so this is a very common technique we would use in planning is to make a gift to that trust. When you make the gift to the trust, though, now we're having to be concerned about what the tax rates are for that trust. And so that becomes an issue there with us. Because the brackets inside a trust are significantly compressed, and because trusts don't have many of the same exemptions and deductions and credits that individuals would be entitled to, generally it's going to be less tax efficient to have an income producing asset held in a trust than it would be for it to be in the individual's name. However, we have some options with that because there really are three different places that a trust can be taxed. First, as long as the grantor is alive, it could actually be taxed to the grantor. And this is what is often called an income defective grantor trust. So it's a gifting trust that's used, but the taxation of it, the income taxation, is taxed back to the grantor. It could also be taxed to the trust, as we discussed, or it could be taxed to the beneficiary. The easiest way to have it taxed to the beneficiary is if the income is actually paid out to the beneficiary. On the other hand, there is one other technique that's very similar to the technique to make it taxable to the grantor. So if you give enough power or enough authority to the beneficiary, then it'll actually be considered a grantor trust to the beneficiary. So this is kind of a unique planning opportunity that can be used in very specialized circumstances. Let's look at another issue surrounding income taxes, though. This one is really looking at the retirement accounts. A lot of my clients have significant resources or assets in retirement accounts. And there was a recent change to the way that retirement accounts are taxed. And that was the Secure Act. It came out in 2020. We had a Secure Act 2 that came out and followed that, and then we had regulations that followed that. Put all that together, and it really makes three big changes, I think, to the way retirement accounts are treated when we're thinking about estate planning. So first off, now we can defer those distributions a little longer. We can actually defer taking any distributions as the participant until age 73, and that's a very valuable option to be able to get those extra few years there. It can be important here for estate planning because if we name the spouse as the beneficiary of the retirement account, the spouse has the option of rolling that retirement account over, becoming the participant on that account, and by doing that, then being able to extend until 73. So, for example, if we have younger couples, maybe in their 50s or so, and we had one of them die, we wouldn't want to have to start having to take money out of those retirement accounts right away and having to pay additional income taxes on those dollars and lose that benefit that we're getting from it. So that rollover ability is very important. If you recall the old laws, we used to be able to do what was called a stretch IRA. And so this was a really interesting technique because we could spread out the distribution to the beneficiaries over the life expectancy of a beneficiary. And so the idea there was just to go find the youngest beneficiary possible, have it so that it's going to be spread out over their entire life expectancy. It could be 40, 50, 60 years. So there's only going to be a small percentage that's going to be coming out any particular year, at least at the beginning. The new system, however, forces that money out over a 10-year period. And that really creates some interesting dynamics when we think about estate planning. Mostly, it's about who, in fact, is going to be the beneficiary. So often we will see that retirement accounts are passing down to the beneficiaries, the heirs, and the heirs happen to be in their best and highest earning years. So if they're in their 40s or 50s, they may be already in the highest income tax brackets. And so even though the participant, maybe the parent in this case, would be in a lower bracket during retirement, when those dollars go back now to their child, they're going to be coming out at the child's brackets, which may be very quite a bit higher since they are then earning and making income themselves. So that's one income tax consideration that comes into it. And additionally, that's going to be coming out over 10 years. We would still be looking at the fact, though, that maybe we don't want to have it go directly to the child. Maybe we'd like it to go to a grandchild. This could be great planning technique if that grandchild is in a lower bracket. We take that money out over that lower bracket time period. If the grandchild happens to be a minor, though, we do have a couple of issues there. We would want to have a trust for that minor. Additionally, under the Secure Act, there's an ability to defer the start of that 10-year period until they become of age. So that could be a very valuable planning technique there. I also like to remind my clients that charities are exempt taxpayers. So if we do have a taxable asset like this, that might be a great one to use for your charitable bequests. Hey, this is a great idea. We'll direct the $100,000 or $20,000 gift that's going to charity from the retirement accounts. They get the full benefit of that, that $20,000 gift, let's say. Whereas if that $20,000 was going to your child, they're going to have to pay the income taxes. And if they're in a 25 or 30% bracket, we could see that coming down, $6,000, $5,000 of tax. So it'd be significantly less that they would be receiving net after taxes. So charities are great beneficiaries for those retirement accounts. And then we also want to consider where the beneficiary is residing. So, for example, if you have a beneficiary who happens to be in Washington, where we're a no income tax state, so it would be coming out at their tax brackets here. On the other hand, if you have another beneficiary who's in California, for example, California has their own income taxes, and you add that with the federal tax, and now we're looking at potentially a 50% or more income tax rates down there. So that would be a significant hit on those retirement accounts in that case. So it might matter where the beneficiary is and who we're going to there. And of course, I'm sure you're well aware of the fact that we do have traditional IRAs and Roth IRAs. And so for those qualified accounts, that are Roth, we have that extra benefit of not having to take distributions at 73 if you're the participant of it. However, the distributions would still start for beneficiaries. So when a beneficiary inherits, they don't get to defer. They have to take those dollars out over that same 10-year period. From an estate tax perspective, this presents another interesting point, because if you do have a taxable estate and we're paying estate taxes, we're going to be paying estate taxes on those retirement accounts also. But imagine now that for that traditional IRA, we're paying estate taxes on the on it, and we are also going to be paying, well, the beneficiary will be paying income taxes on it. So there's really a double tax hit on those. And again, so this makes those a unique asset that potentially is not nearly as tax efficient as we'd hoped. So we do look at that, and hopefully we can work with, or hopefully you're working with a financial advisor or someone who can help steer some ways to address those hidden tax issues inside of that. So, okay, I'm going to jump right into a little bit of a talk here then on the federal tax issues that go along with this. So we've seen the interaction so far between the Washington estate tax, or the Washington capital gains tax, the federal capital gains tax, and the income taxes, and specifically on the retirement accounts, but also considering what kind of a tax situation the beneficiaries are in. When we think about the federal side of this, then let's move on over to the federal transfer taxes, which are the gift tax. And we currently do have a $13.61 million federal exemption against gift and federal estate tax. That also extends to they have a similar exemption for the generation skipping tax. And so we'll talk about that. How is that used? So when you make a gift, then you're using a portion, you're either going to be using a portion of that federal exemption you have available to you, or the gift might qualify for some kind of a exemption to the gift. So for example, many people are familiar with the annual exclusion, that gift, when you can make a gift of a smaller amount to a beneficiary, and that gift will not be taxed, will not use a portion of your lifetime exemption. In the 90s, this was that $10,000 number, if you're familiar with that. It is indexing for inflation and is currently around 18,000 for this year. It'll go up. I'm very sure it'll go up next year also. So 18,000 per beneficiary per donor. And so, a married couple could gift 36,000. They could give 36,000 to their daughter, 36,000 to their son-in-law, 36,000 to their 3 grandkids. It's just, you can move, and a significant amount can be moved at any one time. Normally, gifts would need to be directly to that individual. However, we can use that annual exclusion with gifts to trusts if the trust is specifically designed for that purpose. And so there's ways to include that in a trust. And so that provides an opportunity for us there. Beyond the annual exclusion, other gifts that are excluded might be for medical or for education, but only to the extent that you're actually making those payments directly to the institution. So, if you're paying a hospital bill, that's very, very kind and generous of you, and the federal government has decided they won't tax you for that, for paying that bill, or if you're paying for a grandchild's education, for example, that's not going to be taxable either. So those are a couple of additional ones we have on that. Extending beyond the gift tax, though, we look at the federal estate tax. So again, we have that $13.61 million that's available. So if we didn't use it at death, then we can turn around and we can use it now if we didn't use it on gifts during life, now we can use it at death. That can also be allocated to different types of trusts. So you could have it go to the trust that we were creating for the Washington exemption, for example. So if you gave $2.2 million to your spouse, you could allocate to them your exemption, or to that trust, excuse me, or you could do it to any other gift to a trust that you might be making. Again, we did talk about earlier how we have that portability. And so this is a very interesting feature. So if you have portability, now we have potentially as a married couple, nearly over $27 million worth of exemption currently that's available for gifting. So that's a significant amount. And I don't know if I have a lot more on the estate tax specifically. It's just, figuring out how we're going to interact that with our Washington estate tax planning and our gift planning is normally where we're looking at with that. The GST tax, this is one that I haven't really spoken about yet, but the generation skipping tax is really a tax that is on if you're making gifts beyond your children. You're going to the next generation, down to grandchildren. And the history of this one really goes back to, you can imagine, the Rockefellers and all of the wealth. What they learned was instead of paying taxes at 55% each generation, if they made a gift, say, from the matriarch and the patriarch down to the grandkids, they're skipping a generation. They're paying the tax once, and then the children are going to, they're going to skip their children and go to the great grandchildren now. So by doing that, they were able to cut the estate tax in half over an extended period of time. Well, of course, Congress caught on to that, and they said, well, we're going to add an additional tax onto that. And so, so we do see another tax there. So if you made a gift directly to a grandchild, you're going to need to allocate a portion of your generation skipping tax exemption also, unless there's an exemption. But otherwise, we're going to be looking at, potentially a 40% tax on that, in addition to the federal 40% tax, the estate tax there. So, significant taxes when we're doing that. And so the way that that's used then is we want to allocate that GST exemption. How that really works with Washington State is now we're looking at the tax is the when we're making the gift to the child, is the child's estate now going to be taxable? Are we increasing the size of their estate? Can we do something then so that it will not be taxed in their estate, but could transfer on farther down to the grandchild level without an additional level of Washington or federal estate tax? And so that's when that's our goal, then we do have to allocate and look at that generation skipping tax exemption. Okay. Now, from there, I think we really want to start thinking not only about these taxes, but what kind of changes could we expect, and how would this impact the way that we do planning? And for that, of course, we have something right in the news going on right now, which is the federal election here coming up in the fall. And the reason that could impact us is that we do have this looming change in the cutting in half of the federal exemption. And so when we spoke about that, we might be seeing then, instead of maybe a $14 million exemption in 2026, it could be down to a $7 million exemption per person. Of course, we could have legislation happening. We could have the new president take a different position on that, or the next administration, however it goes there. And it could be extended, or it could be changed to a different number. We just don't know for sure. And often we will see a tax law be one of the first pieces of legislation that comes out after an election, either for a new term or for a second term. It doesn't really matter. They tend to like to get their tax law in, changes in. So how would that impact us here? Does that mean we should start gifting more? Use up that exemption right now, and so use it before you lose it, so to speak. And this is really an interesting point. Maybe, but maybe not. And then how would we use it? So The real problem there depends on the size of the estate. What would be great is if your gifts came off the top. So if you have $13.61 million of exemption and you made $1 million of gift, you would still have, and they reduced it and they cut it in half. They're taking away the portion that was from going from 13.61 down to 12.61, and you're thinking, oh well, it'll drop down to 7 now. But no, in fact, what it would do is it would reduce that million off the bottom. So you would only have $6 million of exemption. So in practice, then it really only makes sense to make gifts because of the potential change in this exemption if you're able to and willing to gift more than half of the available exemption. So we're talking about making a gift of $7, $8 million, $9 million, something like that, so that you can get the benefit of making that gift prior to that potential change. But if you can do that, then great. Yes, it's something we could definitely look at and we could plan for. If for a married couple, you might decide to have one spouse make the gift and not both spouses. So for example, a married couple might say, yeah, we can make gifts of $13 million, but you wouldn't want the $13 million to come from just one spouse or from both spouses, because then you're just using the top. You'd want it to come from just one spouse, and that would eliminate their exemption or a big part of it. But at least then the other spouse would have their exemption available. And so that would be kind of our key on planning for that. I don't know if we're going to get another change in the Secure Act. However, I'm kind of concerned about that because they really kind of came after it. There's a lot of money in those retirement accounts, and from a tax collector standpoint, those dollars all look ripe and ready to be taxed, and so they would love to maybe accelerate that again and do something different there. So we'll watch that. The other one I would be concerned about is probably the capital gains basis adjustment. At some point, it's just too good of a benefit. Many other countries, for example, don't do something like that. Canada uses more of this mark-to-market idea, so they don't really have as much on the estate tax, but they do tax all of those capital gains then at the time of death. And so that could be something that some kind of change could be happening in that realm. Other types of taxes that we would be looking at, tax changes might be around the types of trusts that we can use. There was a proposal to take away the ability to use those grantor trusts that I talked about, those income defective grantor trusts. Now we've had that for as long as I've been in practice, so 30 years here, and it's just become something we thought we would always have. It wasn't really something that was ever a question, but at some point we did have that become more of an issue that the Congress was paying attention to, and in 2021 they actually a bill was actually introduced to take away our ability to do that. Thankfully, that bill didn't go anywhere, but that's where we're at on that. So let's see here. I'm going to go ahead and kind of zip past this now and get into our questions. Before I do that, I do want to thank you everyone for coming.